doggy in the window, the one with the waggly tail. How much is that doggy in the window? I do hope that doggy's for sale.
One of the more advanced topics in finance is that of the cost of capital, and later, as we will see, the weighted average cost of capital sometimes can be convoluted, sometimes overly simplified, or overly made complex. There are 5 major sources of capital. We're going to focus on the 3 biggies, but the first, don't forget about it, it's the short-term accounts payable. It's usually a small proportion to many firms, hence the omission, but shouldn't be forgotten. We're going to look at the 3 traditional ones, as well as a 5th one, which is profits is a source of capital. But let's focus on the big 3. It's from debt, preferred stock if you issue it, or from equity common stock. The first of the 3 biggies is long-term debt. And we usually say, well, because it's tax deductible, it would be the interest expense after tax. Although one could note that maybe it's the yield to maturity, or maybe even more relevant, but a little bit beyond the focus of this presentation, to the call price for the call date. In the case of preferred stock, it's the dividend on the preferred stock over the price of the preferred stock. One might view it historically, but generally one looks at the market valuations. Likewise, for common stock equity, it would be solving the discounted cash flow model, the Gordon growth model, for the discount rate K, here now labeled for equity E, the dividend over the price of the stock plus growth. Well, noting that sometimes you supply the KE with a capital asset pricing model, sometimes people substitute the capital asset pricing model instead. Well, the total cost of capital to the firm would be averaged out, the weighted average cost of capital, sometimes called the WACC attack. And here we're going to omit the preferred stock, but you could add it in, making sure the weights add to 1. And it's the proportion of debt times the cost of debt plus the proportion that's in equity times the cost of equity. And if we just substitute in, well, it's the weight in debt times the interest rate after tax plus 1 minus the weight in debt, because they add to 1, times the, say, dividend over the price plus the growth rate. Sometimes presented separately, but here's as good a place as any to note that one could choose between the two, change the proportions in debts as well, depending on which one is relatively cheaper. And in particular, in the case of equity, if the price of the stock is high, it makes the cost of equity low, and vice versa. And in fact, if the price is very high, you'd probably want to sell more stock, just not because the price of the stock is high, but it is a cheaper source of funds. Vice versa, if the price of the stock is low, it's an expensive source, you don't want to use it, but moreover, it's often a reason given as why firms will buy back their stock. Not so much because the price is low, but they're decreasing an expensive source of funds. And of course, there's variations on the same equation. We could, in the second version, we could substitute in the capital asset pricing model for the cost of equity. In the third version, we recognize that the weight in debt is the debt-asset ratio, and therefore, here I labeled the liabilities so we don't confuse the D in dividends with the liabilities. And of course, the weight in equity would be 1 minus the debt-asset ratio. And here the classic presentation follows, noting that equity is always more expensive than debt. Think about it. Debt is always safer, lower risk, that in spite of the fact that equity is always more expensive than debt, that increasing the equity, making the proportion of it higher, the proportion in debt lower, can lower the WACC, the weighted average cost of capital. And here's your classic graph. And it has some attributes. Well, first, again, the debt is always lower. And it is the case that debt rises at a steeper rate that provides this shallow saucer. And the objective here would be to choose some point where the weights create the lowest weighted average cost of capital. In this case, lowering it by more than a percentage point, somewhere in the middle. Contrast that, if you will, to this case, where there's no change in the weighted average cost of capital. It's a straight, flat line. And moreover than that, it's also perfectly horizontal. Well, that's because the equity and debt rise at the same rates, and we're set to do so. If the debt had been lower, it would then generally fall. If the debt had been relatively higher but still below the equity, it would have then generally risen. But wait, there's more. Look at this rarely presented case where the weighted average cost of capital actually has a hump in the middle. And, well, let's see, properties associated with that is equity is rising at a steeper rate, again, always above the cost of debt. Where do we find this? How about the utilities industry? Marked by the fact that there's a real safe investment in the sense that they have almost a monopolistic guaranteed source of revenues, a lot of hard usable assets, meaning the cost of debt is very safe. And what do they markedly do in terms of their borrowing? They borrow as much as they can, not only because it's smart, but notice also that it moves them to the far right. That makes it actually lower, and in fact they want to borrow about as much as they can. Something to think about with DrCinvests.